Let's talk about performance measurement and responsibility accounting. I really prefer to call this departmentalization or decentralization. You'll see here that in performance evaluation, large companies can be easier to manage if we divide them into smaller units. And that's why I like to call it departmentalization or decentralization. We can call those units divisions, segments, departments, whatever you want to call them, but they're decentralized. Think, if you will, for a second about a big box store like Walmart. You couldn't imagine one person being 100% responsible for managing each area of a Walmart. Rather, there's typically one store manager who basically talks to individual department managers, and those department managers are responsible for really running their departments the best that they possibly can, depending on what their department does. And then that department head or department manager will report back to the store manager, and the store manager thus would have to talk to his regional manager and so on. So when we think about the different types of departments that could be in a store like Walmart, we really can get them down into three different areas. Primarily, it's two areas with one on the side sometimes. Those first two areas are the cost center and the profit center. So let's talk about those first, and then we'll talk a little bit about investment centers later. First off, a profit center. I'll start in the center of or in the middle of this. Too many centers involved there. Let's talk about the profit center. It's the one that we know the most. When we go into a Walmart, we look at the menswear department, the ladies' wear department, maybe the grocery department, the automotive department, and we can clearly see that those departments have two things going on. One, they're making money, and they're also spending money. They do both things. So a profit center is evaluated on its success in generating net income. I'll go ahead and revise that. Generating net income, meaning its ability to generate revenues and its ability to control its costs. On the other side of that coin, we have a cost center. And you'll see in the slide here that it says it's evaluated on its success in controlling costs. It doesn't say anything about income. And that's because a cost center doesn't generate revenues at all. So if we want an example and we're thinking about a store like Walmart, we would think about maybe the housekeeping department in Walmart. It doesn't generate any revenue. It certainly spends money. It has to buy supplies and equipment. And it's very necessary. We need that housekeeping department in order to keep Walmart clean. Other cost center departments that we might think of in Walmart would be the checkout area of Walmart. It doesn't generate revenue. It only spends money. So how does it control its cost? How well does it control its cost? What about the administrative and accounting offices? Those don't generate revenue. They help count it, but they certainly don't generate a revenue. Therefore, those would also be cost centers. And then the third, over there on the right, the investment center is evaluated on its use of basically additional assets or maybe surplus assets and its ability to generate an income on those surplus assets. The easier way to say that is it's an area that takes all of the surplus money that Walmart makes and invests it in stocks, bonds, CDs, or whatever, and it's evaluated on its ability to turn those stocks, bonds, and CDs into additional income. Okay, so we have to talk about this once again. There's a few things that we're going to reiterate as we go through this chapter. This is the idea of a controllable cost versus an uncontrollable cost. And when we got into managerial accounting, we talked all about how managerial accounting is about planning and control. And this is a part of the control function. If we can only really evaluate on a department's level ability to control its cost, what types of costs should it be evaluated on? And it's really just another play on words. I mean, think about it. Controllable cost is the only thing that we should evaluate them on. And uncontrollable cost is outside their level of influence. So we certainly shouldn't try to evaluate them on those uncontrollable costs. So a good responsibility accounting system is one that will relate to the responsibilities of individual managers and evaluate them on their controllable items. Responsibility accounting in and of itself also recognizes that controlling cost belongs to several different areas in management. It's not just one person. It starts at the bottom and it moves all the way to the top. So we really don't just focus on one. It goes all the way through the system. The amount of detail that you get out of any particular area in a responsibility accounting system depends on where the manager is in the organization. A department manager is going to have very, very detailed information, but it's going to provide more summarized information to his or her supervisor, and then that manager, the store manager in this regard, is going to give an even more summarized cost information system to his or her supervisor. And this is an illustration of what we look like. If we see down here, the plant manager has a lot of detail. It doesn't look like a lot, but when you're detailing direct material versus direct labor and overhead, you're getting pretty detailed info. But these totals here are going to go up to the vice president for the West region and just be reported on one line. Then these totals for the vice president of the West region are going to be reported as one line for the executive vice president of U.S. operations, and so on. So as it gets closer and closer to the top, it just gets more summarized. Again, we have to reiterate a few terms in this chapter, so we're going to talk once again, and I think probably for the last time in this course, about direct and indirect expenses and knowing what the difference is. Direct expenses are those that can be traced straight into something. That's what we learned when we started managerial accounting. It can be traced into something directly and is only used for that thing. Therefore, direct expense in regards to departmentalization or decentralization is a cost that gets traced directly to the department and incurred for that department's sole benefit and no other. And on the other hand, indirect expenses are ones that are incurred for the joint benefit. They can't be traced to any one place. Let's talk about some examples. Look there at the bottom. Wages and salaries maybe of for the CEO or for the store manager would be an indirect expense. That's an expense that really all departments are going to benefit from. Rent, the same thing. All departments benefit from the cost of rent. Therefore, rent is an indirect expense, as are utilities, advertising, and depreciation. So you see on the right of that chart, we talk about common allocation bases. What are we talking about here? Well, indirect expenses need to be allocated to all departments. If we have 6 different departments in the store, then the rent needs to be allocated in a pro rata share to those 6 departments. And most likely, the best way to allocate that would be on square feet of space occupied. Anything that happens for the facility as a whole like that would typically be based on square feet of space occupied, such as janitorial expense. The housekeeping department at Walmart would most likely be allocated to all departments of Walmart based on square footage. So let's look at what an allocation looks like. Again, service departments can also be allocated as well, and they have common allocation bases. You can see those here. So let's look at this illustration of a cost allocation. We're talking about classic jewelry, and it pays its janitorial service $800 a month to clean its store. Management allocates the cost to the 3 departments that it has according to the floor space that each one occupies, and that makes sense. So what we see down here is that the whole store is 4,000 square feet, and then we see the square footage of each one of those departments that make up this 4,000 square feet. Well, we simply need to find out what percentage of the store each department takes up. So if I take 2,400 divided by 4,000, I get 60%. 600 divided by 4,000 and I get 15%, and then 1,000 divided by 4,000 I get 25%, making 100% of floor space. Then I simply multiply the percentage of total square foot, or the allocation of the square footage, by the total cost of janitorial expense, and I can see how much I should allocate out to each department. Okay, so in going through departmentalization or decentralization, whichever word you want to call it, really our goal is to create an income statement based on each department. Of course, if it's a cost center department, it's not going to have any income, right? It's just going to be cost. But profit centers will have both revenue and cost. So we have to go through a 4-step process to do this. The first step is to accumulate revenues and direct expenses by each department. Again, some departments won't have revenues, and that's fine. We're just going to go ahead and accumulate those direct expenses. And then we're also going to accumulate the indirect expenses just before we allocate them out. Two then would be to allocate those indirect expenses across all service and operating departments. We're using a service department here synonymously with a cost center. That's what a service center is. Housekeeping, checkouts, business office, and Walmart are all service departments because they're there for the benefit of the operating departments, those departments that have a revenue. Number three is that we're going to allocate then the service department expenses. So we're going to look at all of the expenses in the housekeeping department. We're going to total those up, and then we're going to allocate the housekeeping department itself across all operating or profit center departments. And then we're going to prepare the departmental income statements. Let's take a look. So here in step one was to basically accumulate all of the direct expenses and the indirect expenses. And you'll see that we've done that right here in this column. We've really done revenues as well for those that have had revenues, and that's really easy to do because it's in each department already. But here's our direct expenses, and direct expenses, we're going to know exactly how much of those things are going to apply to each department because they're direct. If I added up this row, it will equal 51,900. If I add this row, it's going to equal 1,500, and so on. And then I've accumulated my indirect expenses, but I haven't allocated them yet. Let's look at the departments that we're talking about. We have two service departments here. One is the general office and another is purchasing. They'll never have revenues because that's not what they do. They only spend money, but they're necessary for the operating departments. Our operating departments here for A1 Hardware then are hardware, housewares, and appliances. So when we get to step two, what we need to do is we need to figure out how we're going to allocate out these indirect expenses across all departments, because even the office takes up space and should take up a piece of the rent. Purchasing takes up space and should use up a piece of the rent and the utilities and so forth. So we're going to see how that happens, and we've got to come up with some decent allocation base. I would think already that rent and utilities should probably be based on square footage of the store and how much square footage each department takes up of the store, and then we'll see what we can do with advertising and insurance as well. So here it is. It got a little wider because here's the allocation base. Again, direct, no allocation, right? We know exactly what's supposed to happen there. But for the indirect expenses, it looks like we're doing rent and utilities on amount and value of space or floor space. Advertising is going to be based on sales, and insurance expense is going to be based on value of insured assets. That's an interesting one. So we've allocated all of these across all departments, and now we've come down to total departmental expenses for each department, whether it is a service department or an operating department. Step three, they kind of combined them on one slide here. Step three was to allocate these service departments out to the operating departments. So this 15,300 and this 9,700 now needs to be allocated across these three departments as applicable. So we're taking the 15,300 away from general office and allocating it to hardware, housewares, and appliances department based on sales in each one of those operating departments. And then the purchasing department, this 9,700, we're allocating out to hardware, housewares, and appliances based on its purchasing orders. So we're going to base it just on the number of purchase orders pushed through. And so what you'll see is that the service departments will end up having a cost of zero at the end because this has all been allocated out, and we'll only have total expenses for the three operating departments. This is step four then, our departmental income statement. Here are our three departments with all cost. Here's a combined total, but you'll see now that the service departments, general office and purchasing, are no longer in columns, but they are now rows allocated appropriately from the previous slide. Okay, I'm going to back up one more time before I continue. Notice here that the appliances department is showing a loss. These two departments are showing profit, but this one shows a loss. And we need to consider, why do we do this? We obviously want to evaluate the performance of our managers. Are they doing a good job? But we really want to look and see if the department itself is making money. A department that has a $500 loss, maybe we would think that we shouldn't keep that department around. And that's why we want to talk about departmental contribution to overhead. The way that we calculate that is to take the departmental revenue minus the direct expenses, and then we use this number to evaluate departmental performance. It is not a function of arbitrary allocations of indirect expense. Here's the thing. Indirect expenses are not controllable in the department. Therefore, we shouldn't evaluate a department based on its indirect expense. So the department might be a candidate for elimination when the departmental contribution is negative. Once again, I'm going to back up a slide and see if we can just kind of figure it out. Let's look at the appliances department. Here is its revenue. Here's its direct cost of goods sold. And then it has some operating expenses. But look, here's the direct ones, right? 7,800, 200, and 100. But then all of these things are indirect. And departmental contribution to overhead does not include indirect expenses. So I would assume then, based on its definition, that we would have to take these costs out before we evaluate the appliances department and whether it is a candidate for elimination. So here's what it looks like. Once I take out all of the indirect expenses, that department is actually contributing $9,500 towards our overhead. And in other words, what this means is that if we took the appliances department away, we would be reducing our net income for the organization as a whole by $9,500. All right. Last but certainly not least, we want to get into the investment centers, that kind of weird area over there. Again, investment center managers are going to be evaluated on their performance to combine income and assets and get a return on those assets. So return on investment, residual income, profit margin, and investment investment turnover are a few of the measures that we want to take a look at. First off, center return on investment, ROI, is going to take the investment center income divided by investment center average invested assets and tell us what we're looking at. Ignore the 21 and 23, if you will, for just a moment, and look at these two investment centers by themselves. If we were to look at these, we see net income for LCD is $526,500, while SPhone is $417,600. Immediately, we would think, wow, the LCD department did better. However, LCD had a lot more invested than SPhone did. So when we actually run this calculation, we'll see that LCD really only had a return of 21% on its assets, where SPhone had a return of 23% on its assets. A much better return on its investment. So maybe we should be telling the LCD folks that they need to talk to the SPhone folks and figure out what they're doing different. Investment center residual income is another performance measure. To find this, we take the investment center net income minus the target. All we're talking about here is saying we want you to at least get an 8% return. And 8% of $2,500,000 for LCD would be $200,000, and it would be $148,000 for SPhone. And how did each division do in relation to its target is basically all we're doing. Both of them did better. They were both ahead of their target, and we would probably say that both of them did well. Okay. What about profit margin and investment turnover? Return on investment is going to be profit margin times investment turnover. So we'll see here, we'll take investment center sales divided by investment center average assets for this one, investment center income divided by investment center sales for profit margin, and then we make that calculation to see where they come out. Here's media networks versus parks and resorts, and you can see their profit margin is 33.5 for one, 18.75 for another. Again, we're just trying to get down into some kind evaluation. When we bring things down into percentages, no matter how big or small one is over the other, we can deal with it in a like denominator. Investment center turnover 0.77 for media networks, 0.69 for parks. Return on investment 25.8 here versus 12.94. Obviously, it seems like media networks is doing a better job. And then still on investment center, balance scorecard is another way that we can look at things. And this balance scorecard just isn't on investment center. This is really on organizations as a whole, really. Again, this is touching on the qualitative nature of a business, not just the quantitative nature of the business. And when we go back to chapter 14, we talked about the fact that in managerial accounting, we evaluate businesses not only in a monetary fashion, but also in a qualitative or non-monetary fashion. And we'll see in the balance scorecard that we look at a few different performance indicators, and we'll see that this is not a cycle. It is not going around in a circle, but each block seems to be playing off of another. We really are worried about our customers, and we're worried about our owners. So we have a customer balance and a financial balance. And how do we look at what our customers think of us versus what our owners think of us? And really, we have to consider our internal processes. Which operations are critical to meeting customers' needs? Are we keeping them happy by meeting their needs? And then innovation and learning. The same thing's happening here. If customers are happy, we're going to make our owners happy as well. Innovation and learning is that concept of continuous improvement. It says, how can we get better? Are we learning? Are we striving to be better? Do we think that good enough is good enough, or is good enough never good enough? It's those types of concepts that we deal with in a balanced scorecard. And that is the end of chapter 22.